Well, I think people should be buying. I think that we have incredibly good basis here in Washington right now. Our deals are cash flowing better than they have historically because we're able to buy at a discount. I think that's pretty undisputed that I'm not going to say we're at the bottom because no one
Hmm.
really knows exactly, but we're buying at a really good basis. And I think that is undebatable. So I would say some people seem to be nervous right now. And I'm like, if there's blood in the streets, buy, buy, buy. That's what we're doing. And I think it's going to pan out for us.
Welcome, my fellow Flow Masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. The degree, the career, the income, but you still feel like there's another level waiting. Here we explore how real estate can become that next challenge worth building so that you can take ownership of your future and truly create a life by design. Now today we're joined by a very special guest, Miss Lauren Rogers, and Lauren is partner at Veritas, hope I'm not butchering the name, Veritas Equity Partners, a private equity real estate firm based in the Pacific Northwest, and she leads investor relations and acquisitions at Veritas, drawing on her background in partner management, sales, and marketing at global tech companies. Welcome, Lauren. Really excited to have you here today. Thank you for your time.
Thanks so much for having me. I'm excited to be here. The intro was great, so not sure that I need to say too much more. But yes, I'm a partner, a co-founder and owner of Veritas Equity Partners. We are based in Kirkland, Washington. We buy workforce housing exclusively in Washington State.
Okay, awesome. Workforce housing. That's great. So, how did you transition from the global tech world to private equity real estate and specifically into this workforce housing?
Sure. I think I'm very similar to a lot of your listeners. I was a quote unquote high performer in tech sales. I started my career at a company called Tableau, which was acquired by Salesforce. And then I moved to Amazon Web Services and worked at Amazon for almost 7 years in Seattle and Chicago. So I was fell into tech after graduate school because that was the region and the market that was
Mm-hmm.
available to me. There are a lot of high paying and lucrative roles in tech. So I had a great long career, decade long career in the tech space, really enjoyed my time, did a lot of global travel. I worked in marketing, sales, channel partnerships in my time at three different companies. And at the end of my time, I was actually looking at real estate as more of a personal investment strategy. I didn't intend to necessarily start raising capital to buy deals. I was
Mm-hmm.
getting frustrated with my compensation structure being mainly in RSUs and then having to transact on those, paying extraordinary taxes, not having cash flow. And so I started listening to Too Much Bigger Pockets, I think, and thinking that real estate investing was super easy and I was going to go that route and buy a fourplex or whatever and get into that world. One of my friends said, maybe you should talk to someone who has experience in this space before you go and dump a bunch of money into an investment
Mm-hmm.
strategy that you don't really understand or have experience in. And I was old enough and wise enough to say, that's a great idea. And I was introduced to my now business partner, Alex Birch, who had a very similar career as myself. We actually worked at AWS at the same time, but didn't know each other. It's a very big company, but knew
Mm-hmm.
a lot of the same people. And he had been buying a specific type of what we refer to as like middle income workforce housing type of apartment buildings in Washington for
Okay.
15 years and had built a really impressive stack of real estate that it put him in a position to be able to think about doing other things, leaving tech and going off and whatever that would entail, but he was being encouraged by some mentors to go bigger. And I think in his mind, he would say, I am going bigger. All of my money is in real estate.
Mm-hmm.
And his mentors were like, no, you need to raise capital because you've come up with a really interesting thesis that's working and you have these impressive returns, and friends and family and stuff were asking to get in on his deals. So
Great.
that just
Yeah.
so happened to coincide with the timing of our conversation, and it turned into me partnering with him to start Veritas Equity Partners. And that was probably coming up, I think it was 2.5, coming up on 3 years ago.
Okay. So it's just the two of you, or any other partners?
It is just the two of us in terms of partners. And then we have a property manager that we hired in the past 12 months. So three of us,
Okay.
and then lots of 1099s, partner, quote unquote partners. But in terms of GPs on the deals, it's just Alex and myself.
Okay. Okay, wonderful. And so he brought you on more, was it more for the capital raising side of things? Because it sounds like he was already experienced on the investment side. It's just, like you said, was trying to scale up into bigger deals.
Exactly. Yeah. So my initial role was pretty much exclusively capital raising. I was focused on the marketing side of things and raising equity for the first year and a half. More recently, we've swapped, and I'm doing now some more asset management, still continuing managing our marketing and our funnels and that type of stuff, but so he can focus more on the capital raising side of things and finding deals, which is really his sweet spot and expertise. And I think when it
Mm-hmm.
comes to raising money, I had a lot of success with it, but people really want to talk to the person that, what sells for us is our track record, and that is Alex's track record.
For
So
sure. Yeah.
we've switched roles a little bit. Initially, he was managing the deals and the assets, right? Because he knew how to do that as well. And
Mm-hmm.
I was more working my network in tech because I just had a lot of people that wanted a different source of income, a different
Yeah.
investment opportunity. A lot of people that were in my shoes of, I have a lot of cash and money, but I'm not getting the result out of my net worth that I'm hoping for. A lot of people in tech, I think, are thinking about other opportunities or wanting something that doesn't just mean I retire at 65. It means, oh, I can maybe retire earlier, or I have another source of income.
Mm-hmm.
So that was my initial role, and obviously still have those conversations. So there's some overlap between us, but switching a little bit more now into managing our property manager and making sure our deals are performing.
Gotcha. Yeah, you touched on this a little bit, but so what are these more sophisticated, we'll call them sophisticated investors, looking for before they wire their funds? And specifically also, I'm curious, I have a big investor or a big engineering network because that's where I came from. Recently quit my job in engineering. And I feel like a lot of people in engineering are very conservative and cautious. Is that how the tech world is too, or not so much, or they may be a little more aggressive?
I think that they are cautious, and I would say in terms of the type of offering that we have, we consider ourselves to be very conservative. Like, we only
Yeah.
do agency loans, we're
Okay.
7 to 10 year fixed debt, we're doing
Nice.
light value add. I know that term gets thrown out a lot. So, we're not doing any permitting, we're not doing any development. There's nothing that can slow our deals down, really. We've done hundreds of unit turns. We know exactly what they're going to cost. We're going in and ripping out carpet, putting in LVP, new counters, new cupboards, appliances,
Mm-hmm.
sometimes refreshing the outside of the building, just making it a better, nicer place to live. And then also looking at rent rolls that have operational inefficiencies. So it's not entirely also based on raising rents, although we do make sure that rents are at least 15% light and that there is
Mm-hmm.
room to improve the property, but we're not dependent entirely on that. And then we're also not dependent on everything going perfect. We are really more focused on conservative, tax-free cash flow. And so I think we align with a more conservative investor. I would say anytime you're doing alternative investments, I think that type of investor I wouldn't necessarily say is conservative in the scheme of all investors, right? Because
Yeah.
they're open
Mm-hmm.
to something unique, and there is an amount of due diligence that they need to do to vet these kinds of opportunities. They're not just handing off
Mm-hmm.
their portfolio to some wealth manager who's going to scrape off of it and put it in index funds. And you can be more
Yeah,
conservative
yeah.
than what we do, but I also think in the scheme of alternatives, we tend to attract a more conservative investor. We're projecting a 15 to 20% IRR. And a lot of our investors say, I don't even need that much. I just want
Yeah.
cash free tax flow that's protected. And so I
Mm-hmm.
think in the realm of alternatives, we're more conservative. I would say in general investing, we're still probably identifying with someone who's willing to think a little bit outside the box.
Yeah. Yeah. Because yeah, I got to explore the rest of the network, but that I have, but the few people that I have talked to in the engineering space, I'm happy with the 401k, the returns I've got. But I feel like most of those people don't really know, and myself included, when I started investing in my 401k, I didn't really know what was what, where my money's really going, how any of that stuff works. And I feel like at least with real estate, you know exactly where it's going. It's going to this deal. Here's our business plan. We're going to show you everything we're going to do. And maybe it feels like there's more risk, but at the same time, everybody needs a place to rent, right? You always need a place to rent. So it's not like housing's going anywhere. We have a housing shortage in most places in this country, right? So to me, it makes sense, but it's like, how do you bring that to them and educate other people on that without scaring them away, kind of thing?
Yeah, I completely agree with you. I'm like, what's more conservative than median income housing? Especially in Washington, there's a massive housing shortage. We're way under permitted. People historically want to live here. This is a desirable market. We have some of the biggest companies in the world headquartered here, really strong economy, not enough land, blah, blah, blah. And so I think in my mind, I'm like, I just don't know what gets more conservative than something you can tangibly see and knock on, and people need space to live. And also within the world of real estate, like, we're not going after the A class, sexiest thing that if people lose their jobs, they have to move out of,
Mm-hmm. Mm-hmm.
or those are people who are saving for a home, more high income earners. Most of our tenants just realistically will not be able to afford to buy a home. We serve people that are making 40 to 80K, and in the Seattle region, a starter home is 700,000, 800,000, depends on exactly where you look. But that can even be conservative. We're buying in Edmonds, the median home is $1 million, and it's just not feasible for a lot of people who need or want to live here and are going to be here long term. So from that point of view, it's very conservative. I also think what I like about apartments when I got into it 3 years ago and started understanding was it's all just math. So we can show
Mm-hmm.
our investors, hey, worst possibility projected, best case, based on
Mm-hmm.
a few different equations. Essentially, it's an Excel sheet. We can show you where we pull the data.
Yeah.
And I think it's just an easy investment for most people to wrap their minds around. It's
Yeah.
not Bitcoin. It's just not that complicated. And yet people will dump their entire net worth into Amazon. That was me. And I was like, I
Yeah.
worked at
Yeah.
Amazon, but I couldn't tell you, what
Yeah.
what was coming, how the
Right.
company was performing as a whole. And I
Insider
just,
knowledge,
yeah,
right?
yeah, it
I
was
know
like,
someone that works at Amazon. I know this stock's gonna go up.
yeah,
Right.
I just think it's wild. And I'm not saying to have no stock or
Yeah.
anything like that. I'm not. I have very little. Most of my net worth is in real estate because that's what I know deeply and understand. But for the average person, I'm not suggesting that you liquidate every asset that you have. But I do think
Mm-hmm.
real estate is a really important part of a portfolio. And if you look at people who are wealthy and the ultra wealthy, there's a reason why they all own lots and lots of real estate.
Yeah, for sure. And then in this market, how are you guys identifying strong opportunities? How are you finding the 15 to 20% IRRs? That's really good, solid return.
Yeah, we have a lot of these buildings, say we typically buy like $4 to $10 million purchase price, and
Uh-huh.
there are a lot of those types of buildings in Snohomish County alone. There's over 1,000 of those that fit that price point, even if you just start there.
Okay.
And
They're off market
so there's
usually, or
no shortage of deals. Off market, I would say it's a mix. Like we do work with brokers, but we very rarely buy something listed. So the way it really works is the broker comes to us and says, "Hey, I have someone that I want to get off the sidelines. I need a serious buyer that I know will close." And so we're underwriting deals all day long that might come from a broker, but they're
hmm,
not listed deals.
gotcha. Okay. Yeah. So I guess I was going to ask for new people getting started because that is a challenging part, right? Is a lot of new people just go to the market and it can be hard to find a slamming 20% IRR that's on the market because if it's there, it's a good deal, it'll probably be gone like that. So I don't know if you have any suggestions for maybe listeners who are newer, haven't done this before, and they're looking for their first deal.
Yeah, I would do what I did. I'm a little biased here, but I certainly don't regret not doing it on my own. I
Yeah.
think the wise move is to align yourself to someone who knows what they're doing, whether it's hey, let me add value for you and capital raise. That's what I did, right? It was like, hey, I can do this
For sure.
and help you in this way. And I just want to
Mm-hmm.
get insight into all of the stuff we're talking, how to underwrite deals and how to operate deals. That was my initial positioning to Alex. Then it turned out that we were awesome business partners, and I'll never go off and do this on my own because we make a really great team. But that's what I would say to someone who's trying to get into it. I'm
Makes
not
sense.
against doing it on your own either. I admire people that just go out and buy a deal, and I think that's a potentially expensive education that's still worth it. So I would much rather do that than pay $300,000 to go to college. It's go put $300,000 down on a deal and you're going to learn a lot of valuable lessons, but it might be really painful. So I do encourage people, hey, throw 50 grand in with a syndicator that you get to know and you trust, and then
Mm-hmm.
you're getting access to all of their investor reporting. You're seeing how it runs. My investors can pick up the phone and call me anytime. I only have like 150 people. Most of them don't, quite frankly, but some of them
Mm-hmm.
do, and they want, because they are this type of person that's, I think, thinking once I double my money a couple times, maybe they pull it out from me and go do it themselves, and that's totally fine. And I'm happy to share all of the knowledge there. So that's my 2 cents, is
Yeah.
get your hands dirty without taking all of the risk,
Yeah.
because when your name is on a loan and whatnot, like there's a lot of beauty in going through a syndicator and just not absorbing the risk.
For sure. And you touched on this with that answer, but are there other ways, or what are the ways that you build trust, long-term trust, with your limited partners and passive investors?
I think number one, just be super transparent. If things aren't performing or something comes up, that just over communicate. And I think people generally in this type of investment are very reasonable. Like our minimum is 50,000, and this is not their only 50,000. I think most people that are investing in this kind of thing understand the fundamentals of investing. They've been doing it long enough where their expectations are not unrealistic. We also turn some people down. Like if we get the sense
Hmm.
that this is their last 50K, or their expectations are unreasonable, we don't take just anyone's money. But when we do, I have a great investor base, which I think maybe is a little unusual. Talking to some other people that have my role, it can be difficult to manage expectations, and I have not had that battle as much.
Yeah.
I also think we communicate really well. And luckily, our deals are performing. We've never done a capital call, or we've never been in an actually hard situation, but we are sending out monthly reports and then a more comprehensive quarterly report. And I think, yeah, and then we also have a newsletter where I'm really active on LinkedIn. We're just starting our newsletter, but getting people more information about, hey, and also here's the market.
Mm-hmm.
And here's some research that I'm doing, and here's why I think my thesis is strong, and continuously educating them on my thesis and what's happening in the market right now. And I think
Mm-hmm.
all those things combined help give people a sense of peace.
Okay. And I know you said workforce housing, so I don't when I think of that, my mind goes to like midterm rentals that are furnished. Is that right or no? Or is this more just middle class America affordable housing,
Yeah, I
multifamily?
would say more think of it as the way I define it, at least, is like median rent. So when I go
Mm.
to, there's a variety of tools that we use, right? And I say, here's the address of this building. My buildings are getting that median, or should be at that median rent number. So we're not doing Section 8. Think,
Uh-huh.
A C class building, take it to C plus, B
Yeah,
minus
yeah,
type of,
yeah,
a 60s, 70s, 80s, 90s build. We're moving up
yeah,
in terms of year built, but woody walk ups,
yeah,
that kind of
for sure.
demographic, an older building in a really
Yeah,
desirable location.
nice. Okay. Yeah, that's in line with what I do. I haven't called it workforce housing, but that it makes sense. It's for that's probably your clientele most of the time, right? It's people in the workforce that are they're not what do you call they're not like the upper class, the A class, high luxury clientele, but like you said, they're not. It's not Section 8 either. So very good.
Yeah, it's just, it's nice, but it's not fancy. Like, that is
Yeah,
what it is. Generally, my tenant base, they're really solid, hardworking people, blue collar workers
yeah,
supporting the tech workers that work here. So my tenants
yeah,
don't typically work at Microsoft or Amazon, but maybe they tangentially support that economy through the restaurant industry, and
yeah,
talking Starbucks as contractors, mechanics, yeah, those type of people. But I'm
for
not
sure.
renting to my investors who are making quite good money working at these tech companies that also surround these buildings.
Yeah, nice. Cool. And then how do you evaluate downside risk before moving forward on a property? So when you're actually analyzing the deal, and you touched on this a little bit too, but maybe just go a little bit deeper on that. Yeah, what are some of the different risks that you look at just to make sure you feel good about it, your investors feel good about it, even if this and this happens, right? It's still going to be a good deal for us.
Yeah, I think debt is the place that people lose, right? So that would be my number one thing. Like, I would never invest with someone who's doing hard money loans.
Mm.
Like, we're not doing any loans on top of agency debts, which is conservative in nature, right? Because it's underwritten by the government, underwrites the operator in terms of their experience. So you can't even get them unless you have a track record of success in that exact
Right, right.
type of building.
Mm-hmm.
So that's number one, is who's your operator? Are they really a specialist in this one thing? Like, I get very nervous when I think there's a lot of capital raisers that are chasing the shiny thing.
Mm-hmm.
And I'm like, then you're a jack of all trades, master of none. Like, you've got deals in Texas and Arizona, and they're all different classes. And now you like RV parks. And it's no, if you want RV parks, go talk to the RV park guy who owns 20 RV parks.
Yeah,
That's great.
for sure.
That's totally fine. But don't get in bed with someone who does it all and their stuff isn't cohesive. But so the debt structure is one big thing. And then our deals cash flow from day one. So we usually tell people, like, give us 6 months before we start doing distributions, because we are going in there, we are turning units, we are creating an asset management plan that requires that some people move out. So we might front load a lot of renovations. We raise our CapEx plan ahead of time, so there's no capital calls, and that's why our raises
Yeah,
are
makes sense.
larger. That's another thing. Like, I've seen syndicators raise $3 million to close a deal, and that's all they have. And then they're expecting to do renovations out of cash flow. And
Mm.
that's crazy. It's like, you don't have that much cash flow.
Yeah,
things like that. What's the business plan and how are you funding
Yeah.
these renovations and who's doing the renovations and how many have you done? And inspections, like our buildings are inspected multiple times, right? Because we have to do it because of the loans we get. We also have a personal inspector that we work with. Insurance does an inspection. There's never been anything that's come up after the fact for us, knock
Good.
on wood.
Yeah.
We know sometimes we'll do it on purpose, right? Like when we get maybe a seller credit or a seller holdback because there's a septic conversion or something, but it's not ever, ooh, surprise, galvanized plumbing. It's like all of that, ooh, new roof. That's part of the CapEx plan. And then insurance policies, ours are, some people do really, they cheap out on stuff where
Yeah.
I'm
Yeah.
like, you're like crazy deductibles, and there's some little details where I'm like, okay, if something does go horribly wrong, are we covered there too? And so I think every place in which we can be conservative, but also our deal's cash flow and we can hold even if the
Yeah.
market dropped, couldn't raise rents. So it's like there's really not a risk. You're not getting as big of a return
Yeah.
as you would like, but you're not losing a deal.
Yeah, that's what I like because a lot of, especially deals that are on market, the brokers put out the pro forma. I've talked about this before. Like they put out the pro forma, which is, hey, they're valuing it based on what they think it can perform at, not based on what it has performed at. And I'm not buying the future. I'm buying what it is right now. Yes, I'm buying something that I do see an opportunity because that's how we're going to add more value. But you want to buy it with a performing T12, a performing income statement that shows if we just do nothing, we're still going to make money. We're still going to cash flow and be solid from day one. So I love that.
Exactly. Yeah.
So in the current economic cycle, what do you suggest that passive investors should be focusing on?
Well, I think people should be buying. I think that we have incredibly good basis here in Washington right now. Our deals are cash flowing better than they have historically because we're able to buy at a discount. I think that's pretty undisputed that I'm not going to say we're at the bottom because no one really knows exactly, but we're buying at a really good basis. And I think that is undebatable. So I would say some people seem to be nervous right now. And I'm like, if there's blood in the streets, buy, buy, buy. That's what we're doing. And I think it's going to pan out for us. These buildings are already performing. And if the environment does change a little bit, then they could really overperform. So I
Yeah.
think when people are hesitant, that's when you buy. But also, there does need to be a shift of expectation setting. Like before my day in real estate, I think it was probably like 2010 to 2021, like you couldn't miss, and
Yeah.
people were doubling their money in 2 years. And my business partner did that, but he would even say that's not what we're selling, that's not realistic right
Yeah.
now. That time in the market was pretty unprecedented, and so people also need to get a reality check of, I think if you're talking to a syndicator or a fund manager who's promising 25% IRR, I don't really buy it. I'm like, hey,
Yeah.
if everything goes right, then sure, maybe like we get some home runs and maybe something crazy happens with the market. But I think that was an unprecedented buying cycle. So congrats to everyone who bought during that time. But I
Yeah.
don't know that's going to happen again. So I think adjusting expectations and looking for stuff that is safe, that is cash flowing, that's bought at a good basis. And if you understand at least like how the operator is defending those things and projecting those things, you should be in a really good spot.
For sure. And if a syndicator is promising anything or guaranteeing anything,
Yeah.
they should probably run the other way, right? Because it's like we're all making assumptions. It's all projected. We're all projecting. But again, that's why I like looking at how is it performing today, and maybe that's like a worst case scenario is if nothing we plan works, nothing projected works. It's just going to keep doing what it's been doing. All right. Last question I got for you is looking to the future. In the next 3 to 5 years, where do you see private equity real estate heading?
Ooh, It's a good question. I think from what I'm gathering that money is moving back into the market. So I actually think that things are going to start getting more competitive in the next year, which is why we're trying so hard to raise heavily right now,
Uh-huh.
because I think the institutions and whatnot are there was a bit of a kerfuffle there when everyone went out and was raising money in during COVID, and particularly in the Sun Belt and some of those markets, like operators are in trouble, and so real estate multifamily has gotten a bit of a bad rep, which I don't think is entirely fair, because I think real estate is very market dependent. So I don't
Mm-hmm.
love when people try to holistically, like nationally
Mm-hmm.
or globally, say this is the real estate market. I'm like, that's no, not particularly relevant to me, but I do think that people pressed pause because there were some deals that some people are underwater. And again, great time to buy if that's the
Yeah.
case. Like, we're not
Mm-hmm.
seeing a ton of true distress in our markets, like truly underwater. That doesn't really, again, that's another reason that I like markets that blue states that have really strong economies. Like, they get a bad rep, but I'm like, they hold steady generally. Or, and if they go down, they come right back, because we're not chasing hot trends. We're not running to Austin where everyone went for 5 minutes and then realized that it was way too hot, and then they got asked to go back to the office. No, I'm not trying to time anything or chase anything. I'm just saying, I know Washington, I live here, we've done this a bunch of times, and we're going to keep doing what we know. And I think that money is starting to come back in, and I do think it will get a bit more competitive. I don't know exactly when, but probably in 12 months.
Yeah. Nice.
Yeah.
Nice. Awesome. Awesome. Hey, I appreciate, your time, all your insights today. This has been a fun conversation. Before we wrap, where can people find you and connect with you? And if they're interested in investing with you guys, how can they get in touch with you?
Yeah, for sure. Lauren at veritasequitypartners.com, or you can DM me on LinkedIn. You can go to our website, fill out the form. Any of those methods are great, and I'm happy to share our deal room, even if someone is just wanting to look for educational purposes. That's totally fine. So hit me up, and yeah, I'm happy to chat high level, send our information in more detail, put you on our newsletter, any of the above, but would love to talk to anyone who's interested in learning more, of course.
All right. All right. Thanks, Lauren. Really appreciate it. And for those of you listening, my Flow Masters, you know how to reach out to Lauren. So if you're looking to get into a deal right now, reach out, see what she's got now or coming down the pike. And I've got my upcoming coaching, my next cohort of Flow Masters coming up. So if you want to get into real estate, you want to learn the fundamentals from the ground up. How do you find and fund the deals, get through the close, execute, and then exit the deals. We'll talk about multifamily. We'll talk about raising capital and partnerships as well. So reach out to me for that. And then I recently started doing health coaching as well. This is just an add-on service that I'm doing because I know I'm focusing on my health. I'm doing a metabolic reset for myself. And 9 out of 10 Americans have this metabolic dysfunction. If you're one of those 9, you've got brain fog, you struggle with energy, maybe you have a weight, you're trying to get your weight back under control, reach out to me and we'll see if we can help. But thanks for listening, everyone. Thank you, Lauren. Appreciate your time, and we'll talk to you next time. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.